Before defining what a stock market crash is, it is important to first remember that SMC is a much more convenient abbreviation. Secondly, a 100% universally agreed upon definition for SMCs does not exist. There is some variation due to the dynamic nature of this phenomenon, though overall we'll find some commonalities that remain relatively constant. An SMC is essentially a price drop, so it is important to define how big the drop is and how long the price drop will last, and how fast does price drop. Here is a diagram I made, conveniently named the crashometer, in order to define the criteria to call a price drop a stock market crash. It is commonly agreed that a stock market crash is when stock prices drop at least 20% for a duration lasting at least 6 months. That is the bare minimum criteria, pun intended, to say that it is a bear market or minor recession. Then anything going towards 30% and beyond for more than a 6-month period becomes a stock market crash of a larger magnitude, going towards a full-scale depression, which is extremely rare. Then on the diagram, you'll notice that the 3 main categories are labeled small, medium, and large correction. It's a convenient method to define price drops, similar to how clothing can be categorized and sized from small, medium to large. The word correction is essentially another way to say price drop. It can be used to refer to price drops in the small, medium, and large categories. However, it is more common for this term correction to be used to define drops in the medium category. When it is a large drop, the term bear market or stock market crash is more commonly used, rather than saying large correction. Likewise, a small correction is a correct term to use. However, it is more common to use terms such as pullback, retracement, dip, or minor downtrend, and downswing. Here is a daily chart of the Dow Jones Industrial Average Index over the 2013 to 2014 duration. It's a perfect real-world demonstration of an ideal path where price rises in an approximate 45-degree angle, going up and up for a long period of time. Then when marking some of the downswings, it becomes apparent why this uptrend was sustained for so long. Stock prices were constantly stabilized back towards that more ideal 45-degree incline. The market was never overextended in that price never rose too much for too long, and there were always downswings to correct the market, as it were. These are all great examples of small corrections, which, as you know, can be called dips, retracements, minor pullbacks, or downswings. Yes, they are small price drops of less than 10% for a relatively short duration of a few weeks mostly. That is why the terms small price drop or small correction can essentially be used interchangeably, because price drops in a small magnitude and duration in order to correct the trend back onto the ideal approximate 45-degree incline. Medium-sized corrections and large corrections, becoming stock market crashes, will have some similarities to this small-scale example, because in concept they are essentially the same thing. Stock prices are dropping in order to correct the stock market that has become overextended, where price has gone up too far for too long. Except the scales will be much larger, with much higher overvaluations and overbought quantities of stock that will result in much larger price drops lasting for a much longer duration. The current chart example is a good example of a healthy stock market with these frequent minor pullbacks. However, the following examples of medium and large corrections will show the opposite of unhealthy markets, and they will demonstrate stock market crashes.